If you think you retire on one or two properties, you're probably playing the property game wrongly. Because to truly replace your income and live off your portfolio, you need a very specific number, a target passive income figure, and a strategy that will actually get you there.
Just talking about fear of debt, a lot of people are scared about getting $2-3 million worth of debt, but the actual key to building a portfolio is actually debt recycling. And we're talking about good debt here, not bad debt. The key is thinking, I'm not going to retire on 2 properties, even 3 properties. You got to set some big goals. But it comes down to reverse engineering what you want in life.
In this episode of the Investing for Doctors podcast, I'm joined again by Rich Harvey, CEO and founder of Property Buyer, to unpack what it really takes to move from dabbling in property to building a scalable wealth generating assets. We cover what your portfolio needs to look like if you want true financial independence from property investing, the difference between buying a house and building a strategy, and how to structure, scale, and even sell at the right time without hitting the lending and serviceability wall.
I actually did a blog about the cost of procrastination, and the cost is huge because if you look at what property prices have done since COVID, in some areas they've moved 50 even to 100%. So you've left millions of dollars on the table that you could have otherwise had in your own portfolio had you started building a portfolio sooner. Start taking action sooner rather than later.
If you're aiming for long-term freedom through property, but you don't know the exact target you're working towards, this is the episode you need to hear. Now, without further ado, let's get into it. Good day. Welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Rich Harvey again with us today.
Great to be with you, B.
Welcome, Rich.
Thank you.
Now, you've been here before, but let's give me like a quick spiel about who you are, what you do, and
Sure.
go from there.
Yeah, sure. Well, I run Property Buyer. It's an exclusive buyers agency. We've been going for just 25 years, so been around the block a few times. We help home buyers, we help investors, we help commercial buyers and developers, but we purely work on the buy side. We don't sell property. We purely work as buyers advocates. I've got 30 staff right around the country. So whether you're looking for your first investment at like 500K or you're looking for your dream home at 10 million, we can help you right across the board.
Yeah.
So yeah, but buyers advocacy has really become a big thing. When I started back in the day in 2001, there was really no buyers agents around, and I've been one of the pioneers of the industry, and yeah, we love what we do.
Yeah, welcome, and thank you for coming on the show. We've previously talked about residential property and, getting one or two sort of very sort of individual property perspective. But I guess when you go on an investment journey, you're not talking about just one or
Correct.
two. You're talking about building a whole portfolio of properties, if that's what you want to do.
Yeah.
And so, we get a lot of sort of viewers that have bought 1, 2, maybe 3 properties under their belt, and, they get stuck at that stage. And the question is, how do you actually build up a portfolio like some of the guys who are talking about 10 properties, 20, 30, or even the 100 property portfolios? Now, let's have a chat about
It's the $1 million question. I'm pleased you asked it because
it's probably a $100 million
well,
question.
it's actually a multiple $1 million question, which a lot of people get scared about. And I'll give you some personal examples, and I'd love to sort of give you a bit of a structure to how I think about portfolio building, if that's okay.
Yeah,
but
absolutely.
I think firstly, just talking about fear of debt, a lot of people are scared about getting $2-3 million worth of debt. But the actual key to building a portfolio, B, is actually debt recycling. And we're talking about good debt here, not bad debt. So the key is thinking, I'm not going to retire on 2 properties, even 3 properties. I think the best thing people can do, maybe watching this podcast, is set some goals. And they might be, what do they call them? BHAGs, big, hairy, audacious goals, right? You got to set some big goals. But it comes down to reverse engineering what you want in life. So for example, if you want $100,000 as your passive retirement income, then you will need, based on a 5% average rental return, you'll need $2 million worth of property invested with no debt. So that means you've got to buy a bunch of properties, pay down the loan, and end up with $2 million. And at 5%, that gives you magic $100,000. Now, if you want $200,000, guess what the magic number is for your portfolio? It's going to be $4 million, right? So you've got to double that. If you want $250,000, it's a $5 million portfolio. Okay, so if you're on doctor's wages, the specialist, right, and you want $500,000 of passive income, you will need $10 million as your entire net portfolio.
Yeah.
So the question is then, how do you break that down? How do you break down? Let's go for 5 million, right? Let's look at a $5 million portfolio, which gives you 250, which is a lot of our investors aspire for that, have achieved that.
Yep.
Okay.
Yep.
I guess, what did they say? How do you eat an elephant? One bite at a time, right? So it's about breaking it down. So the first couple of properties you buy are absolutely critical as in the process. If you buy something that's a slow grower or got very limited rental income, that's going to put you way behind the 8 ball. Okay, that's going to really slow the progression of your portfolio building. The other thing I'd say is you've got to be patient as an investor and let the capital growth do its heavy lifting over time. So it might be you buy 1 or 2 properties and then the market slows, and it could be 2-3 years before you buy your next one, even 4 years. Meanwhile, people are going, I'm itchy, why can't I get money? And just be patient, right? It'll come.
Yeah.
But if you buy a good one in a good area, within 12 to 24 months, hopefully you can recycle the debt, buy $1 million property, goes up by 150 grand, harvest that equity, use that equity to buy your next one and go again. So the trick is to look for properties in locations with capital growth strength and the drivers for that capital growth. Secondly, strong rental income. If you can get both, that's the holy grail. Right?
Yeah. That's getting hard.
It is. It's getting harder, but there are strategies we use for our clients to do that. So I think your point about portfolio building, it's taking a strategic approach. It's diversifying into different locations. It's really drilling down to that location, because that's the most critical part at first. The property type and the physical features of the property are very much secondary to the location. And also diversification. So it's going to be buying in different capital cities in different areas, so you can take advantage of different cycles and property markets.
Yeah,
exactly.
Yeah. And I got to say, the $5 million number looks very scary right now, but in 20, 30 years, that could be a $2 million portfolio today.
Exactly.
That becomes $5 million.
Correct.
But at the same time, you got to think, okay, is $250,000 in 30 years going to mean the same thing as $250,000 today? So what are your thoughts on reverse engineering those numbers?
Okay, well, the fact you raised some good points. You got to build inflation. Okay, inflation. I mean, we've had a spike in inflation, but inflation's a really 2.5% to 3% average over the long term. But let's say it's the higher end, it's 3.5%. Your rents on your properties will increase, typically faster than inflation. Right, the capital growth on your properties should be somewhere between 7 and 8%. So when I crunch the numbers over Sydney, Melbourne, and all the capital cities, but particularly Sydney, Melbourne, Brisbane, the average capital growth rate for each of those cities for a house is between 7.5% to 8% per annum over the last 25 years. So we're not just talking the COVID period, but 7.5% to 8%. Now for units, it's somewhere between 5 to 5.5%. So you're actually getting a 2% premium by buying a house because it's got more land content. Not to say apartments are bad investments, right? But when you look at the compounding effect of that extra 2%, houses will typically outperform the apartments over that period of time.
Yeah. But on the flip side, the rental yield for an apartment is usually a bit higher.
Exactly.
Than a house.
That's right. Yeah.
So it's a trade-off between cash flow versus capital growth, isn't it?
That's right. Yeah. Well, not always a trade-off, but there is a bit of a trade-off. Yeah. I mean, we've got to be careful with these blanket rules that there's no capital growth in regional areas or there's no high yields in capital cities. There are ways around that which we can talk about later.
Yeah. It's almost like a micro environment for every property, because no two properties are the same unless you're buying in a large high density multi-dwelling apartment. Then really the one on floor 8 and the one on floor 9, they're really the same thing. But apart from that, that's quite individualized, isn't it?
Yeah. But when you think about your income goal, like you set yourself up, you've worked hard in your role, in your career, buying properties in that journey is a critical part of setting up your retirement. And the sooner you do that, the sooner you can achieve your goals down the track.
Yeah, beautiful. So, one of the things you mentioned earlier is that you can sort of recycle that debt, get some equity release. What we're seeing is that a lot of people are hitting their serviceability because since the Royal Commission, the banks are starting to cap their lending based on debt to income ratio. How do you overcome that? And I know you can do that with some sort of structuring and planning early, but how are you really approaching that from your perspective?
I'm going to answer that a couple of ways. Number one, have a great mortgage broker.
Yeah.
It's really important you have a mortgage broker that understands how to structure portfolios and buy multiple properties. So Some brokers will only have a fixed number of lenders, but might have to go to what I call second and third lenders to get that extra loan. Like I'm just going through a refinance process myself. I've got a number of companies and trusts, and it's been very complex, but I'm getting a nice big chunk of cash out at the moment and about to go and buy another investment property myself next week. So don't take no for an answer. Okay. So when you get a bank that says we can't afford it, find a broker that can say yes based on your numbers. Another key thing is to make sure you revalue your properties. So just because a valuer says your property is worth 1.5, but you know it's worth 1.6 or 1.7, ask for another valuation. Find evidence and comparable sales to prove the value, so you prove the equity. So what I do is a trick. Whenever a valuation is being done on a property, I do it for the valuer, and I literally give it to them. Because I'm in the game, I know the sort of format they want, but it's literally 5 or 6 comparable sales, and you look whether it's inferior or superior to the subject property. You have about 9 different criteria, but I prepare a short report. I give it to the valuer, and he looks at me and goes, "Oh, Rich, that's great, really handy, thank you." He doesn't copy and paste, but he does actually use some of it because it saves a bit of time. So
it's
I verify
bias as well.
Exactly. I verify for myself what I think the value is. Another trick is to make sure you keep upping your rents. Don't do rent reviews annually. Like a new legislation in most states now, I think Queensland, New South Wales and Victoria, they've brought in a new law where you can only increase your rents typically once a year. So make sure you don't miss that deadline. 2 to 3 months out before the release is renewed, your property manager should be contacting you, but you contact them, get proactive, put it in your diary and say, based on market conditions, can I increase the rent? Because that's going to help your serviceability. That's really important. Another point, and I'm just investigating this for myself at the moment, is even consider doing or turning a long-term rental property into a short-term rental property.
Like an Airbnb?
Exactly. Yeah. If the demand is there. So it's not a blanket, you can do it anywhere. There is an additional hassle factor, and you've also got to make sure it's compliant with council regulations. Because like certain areas like Byron Bay, there's a cap on how many days you can have a property available for short-term
or strata.
Exactly,
bylaws.
or the strata, correct. Because they don't like the party house being in the building, right?
No, they're very against
But basically, the way to improve your serviceability is get the rents up. Another way is look at increasing your job skills. Look at increasing your income. Because the more income you have, the more serviceability you have to then buy properties. So it's that income factor. And another one, I'm sure you're talking to Munzerl about this, is structuring. Is if you, instead of buying properties in your own name, you may look to buy them through trusts or other entities. And there's some smart ways you can do borrowing through those entities. Also, self-managed super funds. The borrowing you do in a self-managed super is completely separate to your personal lending. So they don't look at your personal serviceability when you're buying a self-managed super fund. It's a standalone on the asset that you're buying. And obviously all of this, we're talking about residential, and then in the commercial space you can also have like lease stocks, for instance, that don't affect your serviceability, and but those have its own complications. Exactly.
So that's a lot of strategies very quickly. Where do you find the lowest hanging fruits are in that whole list? Is it upping the rent? Is it
upping the rent's an easy one. It's just an easy one. It's a phone call, an email to your property manager.
And then someone else's problem.
Exactly. But even just jump on online and have a look at what the rents are. And another trick, not just what the rents are, but how much competition there is for rental. Like, I've got a property in Queensland, for example, and the type of property I've got in, I won't say the location, but the type of property I've got there's only about 10 properties, if that, maybe 5 properties available for lease. There's hardly any stock. Now I'm getting $820 a week rent. I can probably go to $850, no problem. There's no problem in putting the rent up. I had one of my Sydney property rents go from, I think it was $11.75 rent to $13.50 a week. It's almost a $200 increase.
Wow.
And I was probably under renting it for a period of time, but that's a massive jump. So, with the tenant was really good and they helped fix a few things and we were kind of kind to them, but that's a massive increase. So that'll definitely spike your ability to get serviceability. So that's a quick win.
Because in terms of the, just to rehash on this, serviceability is calculated based on your income and your expenses for your property,
correct.
But they put a discount on your income. And is that still 80% or are they a bit more?
Again, that's probably a question for the broker, but in terms of the rents, they typically, basically the rent is 80%. They'll take 80% 3%, because they look at management fees, which is somewhere between 5% to 8%, and then just repairs and maintenance and all the ongoing expenses for the property.
And then they also assess the interest at additional.
The buffer rate, 3% higher.
3% higher.
So if your mortgage rate's 6%, they'll do your assessment on a 9% rate. And that's what's killing a lot of borrowing capacity at the moment. You know, like I honestly think, we won't get into this debate, but I reckon they should change that to 2% for first home buyers, for example. You know, have that buffer rate too. But, you know, we're not going to see rates go to 9%. I think it's just excessive.
No, and when it was 2%, it's clearly have gone up past 5%.
That's right.
Isn't it? So it feels like that needs to be...
it's not dynamic.
It's dynamic.
It's not dynamic at all.
Right
APRA that sets that buffer service buffer ratio, they don't ever seem to adjust it for market conditions, right? You know?
Yeah.
Like when interest rates were, 1% cash rate, we should have had a buffer rate of 4%, for example.
Absolutely.
Because 5% mortgage rate has typically been a long-term average, if you look at over the last 20 years or something, or 15 years, I'd say. But they need to make it more dynamic.
Yeah, absolutely. And I think that's one of the, as you said, that's one of the biggest issues. Do you think they're going to come down and change some of that, putting your economist hat on?
The buffer rate?
Yeah.
Oh, I'd like to hope so.
Yeah.
I don't think so, though. I don't think they will. I think there's a reluctance to pour any more kind of what I call fuel on the fire. The fact we're recording this in May 2025. We've just had a rate cut this week.
Yeah.
So we're going to see 3 more rate cuts. So that's going to naturally stimulate the property market.
Yeah. If
the APRA were to now go and cut the serviceability ratio to 2.5% or 2%, that's just going to make affordability even better.
Yeah.
Right. If they reduced it by 0.5%, that's like 2 rate cuts.
Yeah.
So just imagine what impact that has on the lending market and then buyers out there. It makes it more affordable for buyers. So you'll see a lot more people enter the market. And I don't think that would go down too well with government forces.
Yeah, that's interesting. It feels like if they did do that, it would have to be, there has to be some other thing that dampens the market at the same time rather than that in isolation. Yeah, but I don't think government
I don't think they'll do it.
Bright or smart enough to do that, unfortunately.
Exactly.
And so that's the main problem that's stopping people who can afford these properties to buy it, right?
Yeah. Well, serviceability has always been the main constraint, I think, for people buying multiple properties. You kind of run out of capacity to buy. You buy multiple properties, you get to 4 or 5 properties, and then it's like, you're a bit stuck for a while. Yeah. And what I'd say also is don't be afraid at some point to sell one property if that really helps you buy more properties. If by selling
structure.
Yeah, exactly. Yeah. Even just putting money into super or putting money into another company or a trust, again, talk to your accountant about how to structure that. But a lot of the education is there, buy and never sell. And I used to have the same mentality myself. But I think when you actually crunch the numbers and go, you know what, if I did sell and I pay capital gains tax and then I paid stamp duty on the next one, it could actually be worth it to buy more properties rather than saying stuck for another 2 years. So have a look, and it's always, we're using this word dynamic today.
Yeah.
It's a dynamic flow, right?
Yeah.
It's a dynamic thing because market conditions keep changing, interest rates keep changing. So it's a matter of doing that personal assessment all the time. Yeah.
And I'm going to ask you this question. To sort of move one step back to move many steps forward. That's what you're basically saying, isn't it?
Yeah.
But when you're doing that, you obviously have to make sure the numbers work out and have a good accountant to structure the future investment.
Correct.
So you don't end up in the same problem.
Correct.
So briefly describe how can we use structures to sort of improve our serviceability?
So a couple of things. When you're buying properties, you can got a couple of choices. You can buy in your own personal name. You can buy in joint names with your partner. You can buy in a company, or you can buy in a trust, a company trustee for a trust.
Yeah.
Now, there's pros and cons for doing that, and Munzrel is going to be the better person to give you the pros and cons. But I've used both myself.
As typically, in trust and companies?
Mainly just trust.
Mainly trust.
Yeah. A trustee company for a trust.
Yeah.
So I typically I don't buy in companies because it's just not as flexible. I think with the trust, you can do distributions to other entities and move money around. It's so much better. I typically did the trust buying because of asset protection, firstly, and also tax efficiency. Being able to, when I get a big capital gain, I can distribute it to other entities, distribute it to my kids or any other, person I want to distribute the funds to. So it's more flexible. The downside of doing that with property is that you won't always qualify for the land tax free threshold. Yeah. So, in Queensland, it's around 600,000. In Sydney, it's or New South Wales, about 970,000, whatever it is. So you don't get that threshold, and that hurts. So when you buy a property in a trust, you're paying a heck of a lot more land tax.
Yeah.
So you got to weigh up, okay, is it worth paying that land tax, versus the flexibility you get? So again, it's just an equation that your accountant can help you work out when you make that. Before you put the name on the contract, what name or what entity, make sure you've got that advice is my advice.
And do you, in your personal sort of situation, are you using one trust or do you end up using multiple trusts?
I use multiples. Yeah. So typically will buy anywhere from, $2 to $3 million worth of property per trust. Yeah.
Okay. And is there a specific rationale behind that?
Oh, it's more just around asset protection and flexibility around that. Yeah.
Okay. So it's like there's no cross contamination between
exactly. Yeah.
And
you could probably have more. You could probably end up having more. And look, they're going to grow. They've also grown in value, so probably exceeded that limit now. So
yeah. But there's no real. If you can service everything, you could still theoretically put it into one.
Exactly.
Right?
Yeah.
There's really no additional benefit if you can make everything positive.
But in terms of trust, you might have an entity as a trust, which is your trading entity. Keep your trading entity and your asset holding entities completely separate.
Yeah. That's a completely different. That's a different story altogether. You don't want anything trading to be contaminated.
No, that's
holding.
right. Yeah. Or if you're doing a project, like let's say you're doing a development of townhouses or units or something, I would do that in a separate trust as well.
Oh yeah, absolutely. Yeah, anything that
even
involves
if you're going to keep it or
commercial
sell it,
terms.
Exactly. Just keep that for the end.
Yeah, beautiful. And so, like, what would you say? What's the advice a budding sort of property investor who wants to build, say, a $10 million property portfolio? Where is the point where you start to really consider these things, and when do you say, okay, it's still okay to buy in your own name? Is that right before you hit your serviceability cap, or do you have like a blueprint for all of that?
Again, I'm not giving tax advice, but again, the tax advisor is probably the better person to answer the question. But typically what I see happen for a lot of people is they'll buy 2, 3, 4 properties in their own personal name or their wife's name. And then they'll run a serviceability, and then they'll buy the next couple in a trust.
Yeah.
So you kind of use that personal serviceability runs out and then go to the trust.
Or is it more advisable to say before your personal serviceability runs out to start buying in a structure?
Yeah, exactly.
Earlier rather than later.
Yeah, exactly. Yeah. You could try that as well. Either way. Yeah.
Which like in the former situation.
When it's just how the lender will look at the numbers. Okay, so if the lender can disregard your person, a lot of them want to know your whole situation, but it's going to depend on that particular lender and what their policy is. And the lenders change policy all the time. So if a lender's happy to look at, yes, if B is going to buy this property in, ABC Proprietary Limited as trustee for the ABC trustee, and that property stands alone, and they're happy to just take that asset as security, that's fine. Just buy it in the trust.
Okay. So it's really a lender problem.
Correct.
Yeah. Okay. And that's why you need that mortgage broker 100%. To help you
100%.
along the way, and the accountant to help you structure things.
That's
if you're not buying in your
That's
own
right.
Yeah. Excellent. Any other sort of advice we should be sort of, or pearls of wisdom that we should be thinking about before?
I think a lot of people maybe start or have this idea that all the conditions need to be right before they start investing. It might be they've got to get married, they've got to have their business really cranking, they've got to have, X, Y, Z done, but there's never a perfect time, you don't want to be making decisions in a time of trauma, for example, right? In a time of pain. But at the same time, a lot of people I see procrastinate, and I get people that have inquired in our business, and then 2 years later, like I'll tell you a funny story. I was catching up with a guy I played tennis with 5 years ago. I used to play tennis with him every Monday night. And then I bumped into him at the gym the other day, and he's, "Oh, Rich, I've seen your stuff on social media, and it looks good. I must come and talk to you about buying a property." And I remember having a conversation with him 5 years ago.
The same conversation.
Exactly the same conversation. Nothing's happened since, right? So it's like, and so I actually did a blog the other day about the cost of procrastination.
Yeah.
And the cost is huge because you're leaving, if you look at what property prices have done since COVID, right? In some areas they've moved 50, even to 100%. So you've left millions of dollars on the table, that you could have otherwise had in your own portfolio had you started building a portfolio sooner, So my advice is to start taking action sooner rather than later. Is one thing I do, and get the right coach along the way.
Yeah.
You know, using the gym example. I just been to the gym this morning. I did a cycle class. You'd be proud of me, mate. Did my spin class.
Spin
20.
class,
I went 21 Ks in 40 minutes.
Wow.
Got sore legs at the moment, but anyway, it's a great thing. And when I'm in the gym, right, I often it's just some of the tracks are just painful. It's like, how do I get? So I start thinking about something else just to take my mind off the pain.
Yeah.
So I'm thinking, I'm looking forward to doing the podcast today with you, and this is what I'm going to have for breakfast. But then I thought about the coach, and I thought, he's just done a class already. He's already done a 1 hour class, and he's now coaching us. What a legend. And I thought, I need a coach to motivate me.
Yeah.
I wouldn't ride this fast if I didn't have that guy talking and encouraging me up front.
Yeah.
So I guess to your point about what are the pearls of wisdom, get some coaches around you, not just for physical stuff in life, but you need a financial coach, you know, you need an accounting coach, a tax coach, a buyer's agent coach. Like having those coaches around you that you trust and build that network is gold, you know, because I know I wouldn't be as fit if I didn't have those instructors.
Yeah, that's a very good point. And, you know, there's career coaching, there's,
exactly, life coaching.
All sorts of life coaching,
exactly.
all sorts of coaches these days.
Yeah, I use a business coach. I've used a business coach for my own business over time. So, I think the moment you say, I know it all, is the moment you're going to fall into a heap. You know, what they say, pride comes before a fall, right?
Yeah,
you know?
That's right.
So always be open to learning and learning new things.
All right. No, that's all very good. Now, I'm going to do a bit of controversial stuff, right?
Bring it on. Okay, here we go.
Obviously, Labour has been re-elected with a landslide victory, what you probably call that.
Yeah.
And they're trying to target housing affordability. And there's a couple of levers that government can pull. I know one of the things, they've already trying to get the superannuation laws passed, but there's some good, some bad. But that's not the point of the discussion. The point is that they are trying to build over 1 million properties over the next
1.2.
1.2. Sorry, I'm underquoting. Yeah, 1.2.
Yeah.
Over how long is that?
Over 5 years.
5 years, right? Yeah. So, without saying whether they'll pull it off or not, which I mean,
they won't. The simple answer is they won't.
I don't think they will unless they really do some crazy stuff, which I don't think the trade unions will like anyway. If they could get 1.2 million new houses into Australia or new dwellings, because they might not be houses, they might be high rise, high density. What do you think the impact on the market's going to be like?
1.2. Okay, so 1.2 million was a goal set about 1.5 years ago or 2 years ago, right? So they are about when we get to the end of the 5-year period. They're already tracking about 300 to 400,000 dwellings behind that target. So it means they'll only get to 800 or 900,000.
Yeah.
So there's already going to be a shortfall. Now, I don't think 1.2 million is enough. The volume of migrants that have come into this country, in the last 3 years, we've had over 1 million migrants. Okay. Now, most migrants will rent for about 3 years before they buy. So all of those migrants that have been coming in are now getting into the buying cycle.
Yeah.
So there's going to be, again, a continued unprecedented demand for property. There's always generally been a shortfall in Australia. We get to these periods, if you look at the charts, structural deficit, but that structural deficit is going to continue. So to answer your question, 1.2 million, if we got there, great, fantastic. It will help us.
Do you think it will dampen the growth, or do you think
it'll slow the price growth?
Yeah.
Absolutely. I mean, but it won't stop price growth. All I'm saying is that over the next 2-3 years, I think we're going to see quite significant capital growth. Okay, so from a number of factors: 1, shortfall of property; 2, high construction costs; and 3, continued international migration into the country. So we're not building enough properties to keep up with demand.
So with 1 million migration, what's the dwelling to
household formation size about 2.6.
Yeah.
So each household has around 2.6 numbers.
So
now that's been slowly falling as we have less kids. But it's not changing dramatically, if you know what I mean. It's not going to go down to 2 or 1.8 or something like that. So smaller households has often been the key, because you've still got divorce, you've still got people, all those other demographic factors happening.
Yeah, people preferring to live alone. And So that means 1 million migrants over the last 3 years. You need about at least 400,000 dwelling. And so how are we tracking for that?
It's a very good question. I think the Housing Industry Association have something to say about that. They've probably done the analysis, but my forward-looking analysis is we're going to continue to be in a deficit situation, I reckon, for another decade.
Yeah.
And that's simply because construction costs, unless they're going to dramatically come down, like the cost of labour won't come down. Okay, the cost of materials went up dramatically during COVID.
Yeah.
And it's moderate. It's stabilized. Like during COVID, the cost of getting a container ship from overseas was $20,000. I mean, it should be about $2,000, but it's dropped back. So I think those construction costs are more generally back in line with inflation, but they're not coming down. So that's a really big issue. So I think unless there's another way to do building, unless we do prefabbed homes, is a great way, I think, to help solve the housing crisis. Mini homes, but again, that's not going to become necessarily mainstream, I don't believe. We've got Australian building standards, and they have to be met.
Yeah. Do you think that's because Australians are not ready for it, or
I think they're not ready for it? I think it's a cultural thing.
I mean, they're not even ready for high density living.
Yeah, exactly. I mean, NIMBYism. Talk about NIMBYism, right?
Yeah,
that's alive and well. So even though, like in New South Wales, for example, and also to some extent Victoria, there's certain legislation that's improved zoning. So in New South Wales, we have the low LMR, low to medium residential rezoning. So anywhere within 800 metres of a station or a community town centre, you can build up to 3 townhouses or up to 6 units now on a standard R2 block. So that's pretty cool. But why haven't they suddenly sprung up out of the ground overnight? I'll tell you why.
It's costly.
It's not feasible.
Yeah. The unit economics for that kind of scale.
It's great.
It's not good.
It's increased the value of those blocks.
Yeah.
But until you can build them at a cost-effective price, they just don't get built.
And I had a very interesting conversation with an electrician the other day, and he basically said he loves building homes, but the infrastructure projects, which are like tunnels, metro, and all that stuff, is paying him more than twice what he's getting the residential.
Yeah, exactly.
Yeah. So, I mean, that's crazy.
Yep.
And so how can we? All these people are building all these infrastructure projects. And there's still tons and tons of infrastructure projects left to be built. So then my question is that, are we overpaying for these infrastructure projects when the cost of labor is nearly double and sometimes triple?
It comes down to a priority of government. So the government will always say we need to prioritize the tunnels and the infrastructure before we prioritize building more houses, typically. Like that's what the government would probably say. Okay. So yes, that's why the incentive is there to pay those electricians more, even though we need them on the houses.
Yeah. But then ultimately that's our tax dollars that's going to fund all those things, isn't it?
That's it.
So so who's profiting all of that in the middle? Is that a question that we shouldn't be asking?
Maybe it's a question for the Parliamentary Expensive Committee. Like, let's say what's the priority here,
Yeah. I mean, if your people have nowhere to live, I think that's a bigger priority than a nicer road.
That's right.
That then we sell off to some other,
But what's interesting is I saw in the election campaign, Albanese and Dutton debating about housing and affordability.
Yeah.
I was pleased to see Albanese at one point say, the experts have said that removing negative gearing is going to be a bad thing, or words to that effect. So basically got a recommitment from him pre-election that negative gearing wouldn't be touched.
Yeah.
Because that's always been a fear that, Bill Shorten took it to the 2019 election and got hammered.
Yeah.
And Labor said, we're dropping that policy. So it was good to see a reaffirmment to that policy position again. Same with Dutton. Yeah. So it's good to know both sides of politics don't want to touch it. And we know that if you play around with negative gearing, it's just going to disincentivize private investors from investing in property as well.
Can I say, we've had this slight discussion, offline about negative gearing. And I think I just want to reiterate that negative gearing in Australia, I think we're conflating a lot of different issues with under that one term,
Correct.
right? I mean, you as an economist would know this, is that the idea of negative gearing is you being able to deduct expenses from your profits before you get taxed.
Correct.
Right? And that's one aspect of it. But the other aspect of it is that if you are negative in that regard, can you then, put that loss onto somewhere else, right? In many countries around the world, that loss from a property investment perspective cannot be used to offset your income from wages.
Yes.
Right? But in Australia, that's quite a uniquely Australian thing,
That's right.
isn't it?
Yes.
So in Australia, we have capital gains, which falls under its own little bucket. And if you have capital loss, you can't deduct capital loss against your income.
That's right.
And so, but then you can save that capital loss for to offset future capital gains.
Correct. Yeah.
And so I think when we talk about getting rid of negative gearing, which one are we talking about? Are we talking about offsetting your investment losses against your wage income? Or are we saying you can't have any capital loss, full stop? Or are we siloing it, or perhaps even putting that together with capital gains? So if you have investment loss, you can offset that against capital gains.
See, I think it was the previous treasurer, what's his name, Peter Costello, talked about this whole debate, and he said, if you're going to remove it for property, you're going to have to remove it for shares. You're going to have to remove it for any other kind of asset class, which is ridiculous.
Yeah, but the question is that I still haven't figured out to this day which part of those three things are they trying to remove? Are they trying to say you can't
negative gearing? It's the negative gearing against income.
Deduct it against income.
It's against income. That's the main. That's the main one.
So that's the thing. But I think what's happened is that a lot of people are saying, oh, we can't deduct a loss against income. I mean, sorry, losses against the gains. So you can't even write off your expenses. So it's expensing, right? For example, if I'm a doctor, I can say if I buy a stethoscope, I can use that as a tax deduction.
Yeah,
right?
Exactly.
So there are some people who are saying, no, we can't deduct our interest against the rental return, right? That's a whole different conversation.
Crazy.
And I think that's crazy. And they tried that in New Zealand. That's obviously not worked. But then do you think that there is an argument to say we should be standardizing our tax code with the rest of the world by not deducting the losses from investment with personal income?
If I don't think we should. I think the idea of negative gearing as being able to deduct those expenses for investing in property is a great thing, because it incentivizes individuals to do property investing. The problem is if you took that away, you're going to be reliant on institutions, major institutions and companies and government to provide housing. And we know that the large number of, I think it's 80% of negative gearing is done by mum and dad investors.
But can we, So then the question is that, can we say with that loss, we deduct it against your dividend income? You can still deduct it, but it's just not against personal income. Like,
I just think it's going to remove, I think if it was changed,
it'll cause a lot of problems.
It would just be, it'd be a major upheaval. It'd be a very problematic thing for property supply in this country. Be a major issue. Yeah. So that's why
I don't think there's appetite to do it, because that's just a hugely unpopular thing. And even politicians are taking advantage of it in a way. But if you were to compare Australia with every other country, no other country has that.
But what we need to have in this country is a proper discussion and execution of tax reform. So the problem is that our political cycles are too short. They're only 3 years, not 4 to 5 years. So any major thing like a GST, trying to get through was fantastic. That got through. That's what we need more of, and have a holistic look at our tax system. Like, we pay way too much tax on income. We should replace stamp duty with land tax. And I think just the disincentive for workers on the average wage is just terrible. Like, it's this whole, you're working for the government for virtually Monday to Wednesday, and then you can get some income for yourself in the last 2.5 days of the week.
I mean, there's lots of countries that have made use of a great sovereign wealth fund.
Yeah, exactly.
And it feels like we are not taking advantage of all the stuff.
Look at Norway,
look at Norway.
I visited Norway last year, right, as a case in point.
Yeah.
And just talking to them, they're just happier people. Like, education is free, their healthcare is amazing, and they just seem a much more, even though they live in darkness for 6 months of the year, right? They're a happier people. I mean, their wealth fund's phenomenal. Like, very lucky with their oil reserves, right? But very smart country.
But even if you look at Singapore,
why aren't we doing that with our minerals?
Our gas,
and our gas,
right? Yeah. Well, that's another question for the government. But also, like, if you look at someone that's resource poor, like Singapore, they've got a huge sovereign wealth fund. Their taxes are probably one of the lowest in the world.
Fantastic, 15% tax. That's why all the expats go and live there and never come home for about 10 years.
Absolutely, 15 years, right? You can go there, build up as much. Well, there's no taxation on dividends. There's no taxation on interest. There's no capital gains tax there, except for limited circumstances. But if you try to buy your second investment property, they'll slap you with I think it's a 40% stamp duty.
Yeah.
Or something like that.
Yeah.
It's some crazy amount,
Yes.
right?
Yeah.
But because they are a land poor country.
That's right.
So they can do that.
Yeah.
And in China, where I was born,
Yeah.
they you need a permit to buy investment property or even buy any property. So that's how they keep their underfold.
Classic.
But in the US, for instance, in Australia, we don't have those sort of things. But it's a different.
I think maybe just to bring the discussion back to property and all this, is because we've got a particular tax system at the moment, the way it is with negative gearing and everything, and we've been talking about the shortage of property. Yeah. The good news for the listeners out there is that investing in property in Australia for the next 10, 20, 30, 50 years is a very good strategy.
Yeah.
So I think, we don't want to be the bearers of, the political system stuff, so don't invest in property.
No.
The best thing is that I'm excited as an active property investor and encouraging my family to do the same is get into property because it's going to set you up so well for the future.
Yeah.
And there's going to continue to be shortages of property, which is going to continue to have price pressure. So,
and I think the reason why we went down that little rabbit hole is that the system incentivizes the way things are, and everyone works within the confines of the system.
You've got to learn how to work the system to your advantage.
Exactly.
So I'll give you a case in point. When I was talking about portfolio building, I was an economist in government for 10 years and I was sick of crunching numbers and I started buying properties on the side. And when someone sat down and explained to me and got a spreadsheet out and said, Rich, here's your income. You can buy a property tomorrow for this one. I went, oh, that's good. And then I went, well, I could actually buy 3 properties, couldn't I? And I said, yeah. So I went and bought 3 properties in my first year.
Yeah.
So when the lights went on and I used the system, using OPM, using other people's money, i.e. bank money.
OPM.
Okay. OPM's a really good thing to get addicted to, right?
Yeah.
Not opium, but other people's money.
How that turned out, yeah.
So put that on the captions, that'll be fun.
Yeah.
But using bank leverage, that's why property returns kill share investing. So if you look at average returns on the ASX, it might be 12, 13%. Property are getting 7, 8%. But the factor of leverage, the fact that I can leverage to minimum 80%, if you're a doctor, 90, 95%, you got it lucky, right? So you should. It's fantastic. So I often have people coming to me and they've got an approval for, say, $1.2 million to buy property. And they go, oh, Rich, I might just spend around 7 or 800. And I'm saying to them, that's fine. Why?
Yeah.
Well, I just want to keep some in reserve. But I say, well, I can get you a better quality property. I might even be able to get you 2 at 600. Why wouldn't you spend that? And they go, oh yeah, that makes sense, right?
Yeah.
So I think we've got to challenge our own mindsets around debt and around structure and around strategy, so you can move forward faster.
Oh no, I'm all for it because this is the way that the macroeconomic system has incentivized and built it this way. But if people are saying, oh, you shouldn't be doing that because you're a greedy investor, landlord, all that sort of stuff. I was like, well, this is what the system has done. It's built it this way.
Well, it's designed that way
exactly
to encourage those incentives.
Well, yeah.
I mean, it's often people use the word dodgy with developer or greedy with investor. It's like, well, hey, they're actually trying to make a profit, which is the economy, which is what the circular flow of income is all about.
Yeah.
Hats off to those that actually get out there and do it.
Yeah, absolutely. And the thing is that if we as a society do not want this, then that's what government's for, lobby your government and change it. And so that's where they should be focusing and their attention at, and not just going on social media and commenting. Gonna get a lot of hate for that.
Lots of keyboard warriors out there.
Lots of keyboard
that
warriors
hate property
out there.
investors. They wrecking the country. Well,
the government has built it that way, and that's all I have to say. And who voted the government? You did. So we're all in this together. So I think that's a bit somber. Any take-home words for those that want to build a big portfolio?
I think also too, when you get to the point, let's say you're 15, 20 years down the track, let's say you've got your $7 million, $5 million worth of property, $10 million if you're lucky or more. There's a point at which you can go, I can actually slow down now. And a lot of people don't. They don't know how to stop or reconsolidate. There's a point at which you build a portfolio and you can, what I call, recalibrate your portfolio. So if you're in your late 50s, early 60s, you might want to get to a point where you've got some still maybe negatively geared properties. Hopefully they're not negatively geared by that stage. They're bringing enough income.
Yeah. But the whole portfolio is not going to be.
Exactly. The whole portfolio should be generating cash.
Yeah.
But you might want to sell down one or two and redistribute, maybe sell something and buy higher yielding assets. So you might want to buy some commercial property. Buy sell 2 resi, buy 1 commercial. Or another strategy I'm doing is buying a rooming house, which can deliver returns of around 8 to 10% per annum. Okay. So you can actually restructure, particularly getting stuff into your self-managed super fund, even though you got these $3 million caps supposedly coming. It doesn't matter. If you've got a partner, you've got $6 million to play with, right? So use that. It's not as bad as what it's made out to be. So recalibrate your portfolio and set yourself up for a really.
I think don't be afraid to sell. I think that's the main thing. There's a lot of fear in selling, and if the opportunities are right and the time's right and the numbers are right, sell because sometimes you can take a step back to go forward.
Exactly, that's right.
Yeah. All right. So that sounds like very good advice, and thank you for joining us today.
Pleasure. Thanks, B.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.